Good morning. My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. A very warm welcome to our GFM clients and guests this morning, this very dreary and rainy day in Melbourne, for an update on three of our favourite listed investment companies: Australian Foundation Investment Company, Djerriwarrh, and Mirrabooka. And respectively, the stock codes for those companies are AFI, DJW, and MIR. I'll formally introduce our speakers in a moment, but as many of our clients know, our firm GFM is a massive advocate of investing in listed investment companies. We see the beauty of investing in a listed investment company as, via the ASX, having access to a professional fund manager that can provide you portfolio diversity, often with favourable tax implications, including franked dividends, and most importantly, access to what we hope is a reliable and growing revenue stream via dividends. Now, not all listed investment companies are the same. You've got to be very careful when looking at which listed investment company you invest in. And broadly, the markers that we as a firm are looking for in a high quality listed investment company is that they're run at a reasonable cost, they have a strong reputation, and of course, they have a sound investment philosophy with hopefully a good long-term track record. Fascinatingly, when focusing on Australian Foundation, this listed investment company was founded in 1928, so it's nearly 95 years old. It's Australia's largest listed investment company, and I would argue probably the most successful. The same applies to Mirrabooka, Djerriwarrh, who have both been also running for multiple decades. So I'm absolutely thrilled this morning to have a great panel of presenters to talk about these companies. Firstly, I've got Mark Freeman, who's the Managing Director of Australian Foundation, Mirrabooka and Djerriwarrh. Good morning, Mark.
Morning.
And I've also got the portfolio managers for Australian Foundation, Mirrabooka and Djerriwarrh, David Grace, Kieran Kennedy, and Brett McNeil. So good morning, guys.
Morning, Paul. Morning, everyone.
Right. So before we get underway, as is customary, we have our standard disclaimer. Any of the information that we go through this morning is not specific to your personal situation. This is general information. So for any of our clients or guests who are listening in this morning, if you've got any further questions around what we discussed today, please don't hesitate to talk to one of our advisors. So firstly, let me start with you, Mark, if you don't mind. Do you mind just giving us a little bit of a background and history into these companies of which our clients are investing?
Sure. And as you pointed out, we actually run 4 investment companies, but you've highlighted 3 of the largest ones within our group. And as you said, AFIC, Australian Foundation's been around for over 90 years. So look, I think the thing that makes us a bit different is the listed company structure. Being a company, you get the transparency from being a listed company. We have a board of directors. If you take the time to have a look through our directors, they're all experienced business people, and they add a lot to the process and also to the governance. You can see our accounts. An important part of what we do is making ourselves available and accountable to our shareholders. The other key feature is that there is no external manager involved with this group. So there's no management fee going to a fund manager. The shareholders own the companies. And the costs to the fund is really, it's a cost recovery process only. And so I think that's a very important part of the process. And with that means that there's no performance fees at all on any of the funds. Once the costs are recovered, all the benefits then go back to the investors, who are the shareholders, who are the owners of the company. I guess the other element of our approach to investing is most of our investors are retail investors, and we deliberately want to be low turnover because we understand that if you trade or buy and sell shares a lot, you get a significant impact from tax. Most other fund managers don't care about tax. They develop fees and performance fees based on pre-tax performance. We don't think that's right. Tax is a significant drag. We want to avoid tax. So therefore, we want to be low turnover. Therefore, our approach is to try and invest in companies that we want to be a long-term investor in. And then again, that gets back to this idea that we're not trying to trade share prices. We want to be investors in businesses. So if you quickly look at AFIC, we focus on Australian, New Zealand companies. The MER, or the expense of running it, is 0.16% with no performance fees. So that's the only cost the investors incur. AFIC has about 60 odd stocks. It's broad-based. We want to be diversified. We do have that focus. We want a mix of yield and capital growth, but David will touch on that a bit more later. Djerriwarrh is primarily an income fund. It's really good product for people who want franked dividends, but we do want a little bit of capital growth over time. You can see there the MER 0.45%, again, no performance fees. Mirrabooka focuses on small to mid-cap stocks, so anything outside the 50 litres. MER 0.46, again, no performance fees. And we do also have a fourth fund called AMSA, which is our high conviction fund. So perhaps we move on to the next slide. And I think, Paul, you wanted me to just touch on our investment approach.
That's right, Mark. Yeah. Broadly speaking, what is the general investment approach of the companies?
Yeah. So as I said, to be low turnover, we want to be a buyer and holder, which means we want to find companies we can stick with for the long term. And so to achieve that, what we talk about is we want to be in high quality companies. So some of the factors we look for is businesses that have a leadership position in the markets in which they're operating in, or they're developing one. We like companies with unique assets that are hard to replicate. We don't like companies that carry too much debt. It brings with it too much risk. We're wary of companies that have too many what we call external factors, so factors that are outside the company's control. We prefer companies with more consistent earning streams. The people running a business is really important. So we want management teams that are effective, passionate, and have ownership alignment. And we want to be in companies that can grow their profits and therefore their dividends over time. So the outcomes of those is businesses that produce strong, sustainable competitive advantage. This results in companies that produce a high return on capital. That means they can invest in their own company and make really good profit returns. They can reinvest to drive growth. That'll lead to further capture of market share, which further enhances their leadership position. And this will produce long-term shareholder value creation, and that includes dividends. So that's what we look for. And then we follow companies. Another key factor in being a good investor is then to try and buy these great businesses when you see value, which often means being patient. And it's been interesting in the market. We've seen it more recently with the sell-off. We start to see some interesting opportunities in good quality companies. So our mantra is stick to the quality and buy when we see value. So that's the approach we put across all four of our funds. But the team can go into more detail on that. So, again, just to highlight, we're not trying to trade share prices. We want to be investors in good businesses and stick to that approach over time.
Fantastic, Mark. I really appreciate the introduction. So look, we're going to now focus on Australian Foundation Investment Company. Thrilled to have David Grace, Portfolio Manager, with us. David, I'm going to move on to you. Do you mind, firstly, just stepping us through the performance of Australian Foundation Investment Company in the last 12 months?
Yeah, sure. So just to give you some context, perhaps, Paul, if I can go back a little bit further, and it's really in the context of the comments Mark was making. So we aim to be low turnover, long-term holders in quality companies. And it's very much that buy and hold approach. So as long-term holders, we really seek to benefit from the compounding returns and the value that they can add, particularly when you're invested in quality names. So we had a really strong FY19 to FY21 performance, and you can see that reflected in the 3-year return and even the 5-year return being in line with the benchmark. However, the last 12 months, we had a disappointing year with the portfolio down 10.6%, with the market down 6.2%. Interestingly, consistent with our approach, it's many of the same companies that have delivered really strong value for us on a 3 to 5 year view had a disappointing last 12 months. And I think the anomaly in all of that is just the aggressive run that many of these companies had in calendar year 21, particularly towards the back end, where we saw many of these companies get to really unsustainable share prices. So during that period, we trimmed a few of our holdings, but consistent with that long-term approach, that was really at the margin. And some of these companies have fallen 30, 40% this calendar year to date, but we still feel they're really good quality businesses. They have excellent long-term prospects. And in that regard, we're talking about companies like CSL, Fisher & Paykel, Healthcare, Goodman Group, Xero, Reece, Macquarie, Car Sales, and ARB. So now getting back to levels that we would say is more reasonable in line with the growth prospects of all of these companies. The other point just to highlight in the last 12 months was the strong performance of the energy sector. So with the Russian invasion of Ukraine, energy shortages, energy security became a real topical issue. You saw LNG, oil, and particularly coal prices rally quite aggressively. And the largest driver in the energy sector were the coal names, with many of the pure play coal companies up over 200% this calendar year to date. And we don't own any of those within the portfolio. And the third point I'd call out is just the overweight that the portfolio has to healthcare. And while it wasn't materially different, it was down 9%, so it underperformed the ASX 200. Our largest exposures in the healthcare sector are to CSL, ResMed, and Fisher & Paykel. Now, we would classify all these businesses as being very high quality, and yes, they got overvalued, but the long-term opportunity and the market position that each of these businesses hold still remains very strong. And importantly, they provide pretty resilient earnings profile in what's a challenging economic backdrop that they're facing at the moment, and all of these companies have excellent balance sheets.
Yeah, thanks, David. Look, clearly of recent times, it hasn't been an easy period to invest. And as you alluded, we are certainly entering a period of more difficult economic conditions. So would you mind spending just a few minutes talking about the way you have your portfolio set based on the variety of different economic conditions that we have at the moment?
Yeah, sure. Thanks, Paul. So you think about just holding on for the long term. We don't want to have the portfolio tilted one particular way or another. So we're not trying to pick short-term cycles in the market or just trying to get a sense for what looks incredibly cheap and trying to tilt the portfolio too heavily in one particular sector. So the way we like to think about that is we break it into these 4 quadrants effectively. So first of all, we want to have good diversification across the companies and the sectors we're exposed to, but then also into the attributes that the companies bring. And so it really gets back to being able to identify the specific reason as to why a company's in the portfolio and the role that it's ultimately playing. And we look at this chart and say it's really a mix of growth companies on the left-hand side, be it growth and cyclicals. And on the right-hand side, it's more about income. So that's the stalwarts and those defined as income. And if you think about the growth companies, these are fantastic assets, fantastic businesses in a really strong position, generating a lot of free cash flow. And it gets back to the earlier point. If we look at just some examples in that quadrant, so take Goodman Group, Macquarie, for example, they've really fallen quite materially over the course of this year. They've now, the multiples are back actually below their long-term average multiples. And we see the operating environment remaining challenging, and we expect to see some earnings risk for companies, but at least the price you've been asked to pay for these companies has fallen to levels that we would say is reasonable, particularly for high quality companies. And the other one to call out, James Hardie, there's clearly some challenges going on in the US housing market, and we don't profess to know the answer about how that all gets resolved. But the multiple you're paying today for James Hardie's pretty much the lowest it's been at any time in the last 10 years. And the net debt balance is really, really low. So we feel the prospects for the company are strong with some short-term challenges ahead. And if we just move around the pie charts, the stalwarts, we do expect a growth in earnings for all of those companies. But this is the likes of Auckland Airport, Wesfarmers that owns Bunnings, Woolworths and Transurban, just highly strategic, difficult to replicate assets that puts them in a really strong market position. And even in tough times, consumers and their customers need to be able to use all of the assets that these companies provide. And then the income comes largely from the banks and the likes of Telstra. And we just recognise the importance of income for total return. And then if I look at cyclicals, the bottom left-hand corner, that's typically BHP rather than BP, but these are companies that are exposed to a cycle. They're very much leveraged to positive economic growth over the long term. And we're really cautious around the balance sheets given the nature of the cycle for all of these companies. So low cost, tier one mine life for the miners in BHP and Rio, and Santos and Woodside, we feel are in a position to generate more meaningful cash going forward.
Now, I'm not after an economic update here, David, but clearly as a portfolio manager, you need to be cognizant of the economic environment. So would you mind just stepping us through some of the variables that you're seeing in the economic environment that you need to be aware of when looking at the way you're investing clients' funds?
Yeah, there's a few challenges at the moment, and we're certainly not economists, and the way we think about things is bottom up and trying to pick good quality companies that have a habit of being able to come through challenging times actually stronger and typically take market share. So at the top, we've listed 5 things that are occupying investors' minds, and not to run through them in detail, but there is a pretty exhaustive list at the moment, and that's reflected in the fact that investor sentiment is pretty poor at the moment, and you've seen the market pull back over the course of these 12 months. And what typically happens in times where there is a fair degree of uncertainty is investor sentiment moves very short term, and share prices get driven by very much the news of the day. So we see that as an opportunity where if you've identified the quality companies and you're determining at what level you're prepared to buy more, generally times like this throw up opportunities to add to our quality names. And it gets back to that earlier point where I said we're identifying a number where valuations now are far more reasonable than what they've been any time over the last 12 months. I think just a couple of points. We've just come back from a trip to the US where we went around and saw a number of companies around within the portfolio, getting insights into their US operations, as well as catching up with many peer companies and others that we don't own. The sentiment over there just feels increasingly more cautious. So at the moment, it's challenging 2 parts. So all the official economic stats, which are backward looking, still look positive. However, the sentiment from the companies is that they're finding conditions or expecting conditions to get a bit tougher. They're very focused on the cost base. So our expectation is that things will slow down next year. But as I said, selectively valuations are reflecting that. Look, our view, talking to many Australian companies, is the Australian market feels in a better position. We're not getting the same degree of caution from Australian companies. While they do expect to see some challenges, we would say that it's not at the same level as what we experienced when we recently travelled to the States. But I think in times like this, you really see better quality businesses come through, and it gets back to those that have highly strategic assets, have a degree of pricing power, and they're not reliant on having to continually attack the cost base to grow earnings. And really most importantly is those that have a really strong balance sheet and are able to wear the hits and volatility as we go through these periods. And look, our view certainly is that the portfolio is heavily skewed to these companies, and it gets back to that long-term approach of identifying and investing in quality companies.
You alluded to this already, but I'm very keen to get your view on how you see market valuations at present, and perhaps you could step us through some of the recent portfolio changes within Australian Foundation.
Yeah, sure. So just not to repeat, but just on the valuation side, and averages can be dangerous, but this just gives you a high-level view. I think the first point to call out is where valuations got to at the end of 2021. This is shown clearly on the charts where they were trading well above long-term averages. And you can see now on the price to book on the left-hand side is now more in line with long-term, and price to sales is heading there. So both of these charts are a high-level snapshot of the overall market. This is the ASX 200 on both of these metrics. And I think the takeaway for us is that things are looking fairer value than what they have, say, 12 months ago. And just putting that into a really long context here, we've shown the ASX All Ords over the last 80 years. And you can see all the events, the external events that have disrupted or caused headaches for equity markets over that period. Despite that, the trend has been sort of bottom left to the top right-hand corner. And I think when you see sharp pullbacks in market, that they typically recover. And this is just evidence if you take advantage of those opportunities, you deliver pretty good returns over the long term. And then in terms of changes to the portfolio, so if we start on the left-hand side there, we've sold out of Cube and Endeavour Group. really Q was on the back of an asset sale. We quite like the Moorebank asset, which the company disposed of. And Endeavour Group, we see longer term challenges in relation to their hotels business, where a large percentage of the profitability comes from the pokies business, which we see longer term challenges for. And then Milton and Sydney Corporation both were acquired in the year, and that actually caused quite a tax drag on our performance in the earlier chart that I showed. What we've been doing, I guess, consistent with what we were talking about earlier, was just adding to existing holdings where we feel valuations are more reasonable, and particularly where we still have confidence that the long-term prospects remain strong. And you can see sort of 10 to 12 there on the far right-hand side, and equally there's probably another half a dozen that we've added to more recently, and just using this opportunity to make businesses that we think are really well positioned for the long term, larger parts of the portfolio. And when you manage through times of uncertainty, you don't want to come out owning the same number of shares in businesses that you really like. So we're just picking them up as valuation present. And in the new columns, which are the new purchases, the middle column there, we added JB Hi-Fi and Mirrabooka to the portfolio. And if you take JB Hi-Fi, for example, its long-term multiples about 14 times earnings. You're buying that currently at 10 times with a 6% dividend yield. And while the consumer environment is, people are cautious, we feel the valuation discount warrants a purchase of that company. And then Mirrabooka the same, where we've seen a sharp sell-off in REITs, where Mirrabooka's now trading at sort of 25 to 30% below NTA. And while there may be some impact on the NTA, we think 30% would certainly be very extreme. And then WiseTech Global, which is a growth company that we think's got a fantastic software solution for many freight forwarders, and really replacing legacy systems and making them far more efficient. So we think the opportunity for this business remains very, very strong.
David, I really appreciate the update on Australian Foundation, and sincerely thank you on behalf of our clients for the outstanding long-term results. I'll now shift focus, and we'll have a little bit of a chat about Mirrabooka. So Kieran, welcome into the webinar. I wouldn't mind starting, Kieran, with you just explaining, as we know, Mirrabooka invests in companies outside the top 50 on the ASX. Do you mind just talking about what you see as the attractiveness of investing in companies outside the top 50 on the ASX?
Yeah, thanks, Paul, and good morning, everyone. So I guess to put it really simply, the reason you sort of move into small and mid-cap companies is really to try and capture greater long-term total shareholder return, and particularly on the capital growth side of the equation. And look, there's no free lunches in markets, but the reasons that's available is there's a bit of a discovery premium available. So a lot of these companies aren't particularly well covered. So if you can go out and do the work and capture them and recognise the quality early in their life, as others follow that work, you do get a valuation pickup. So that's really helpful if you're sort of sifting through the market and finding the right companies. And then the other point is, if you identify them early and bought them well, I guess you just get to experience that growth curve for a company for longer. Companies go through life cycles where they've got something good to offer the world, and they grow particularly well, but then inevitably you reach maturity at some point in time. So if you can step into that earlier, you just get more of the years in those companies where returns are higher than the market offers. As I mentioned, there are no free lunches. So on the other side of that, if you're just looking for an index and you're sort of saying, I'll move away from the large cap index into small and mid caps, you're going to take on more volatility and you're going to receive less dividend yield out of the companies in this end of the market. So I think one of the things that makes Mirrabooka unique in that is we've really tried to address those two limitations in small and mid-cap companies. On the volatility side, what we're doing is being really particular about a quality long-term focus. So we don't invest in concepts and startups. We don't trade shares. It's all, what Mark identified early, really quality assessment of companies and being a long-term investor in them. We think that does manage that limitation somewhat, but you do accept that the volatility will be higher than AFIC here. And then the other one on the dividend side is, given the track record of Mirrabooka, we've been in operation since 1999. We can supplement the dividends that the companies pay us with the realised gains we generate over time. If we're picking stocks well, companies get taken over more often here. They reach extreme valuations. They might move out of our index into the top 50. So there's more reasons to sell them. and generate capital gains, and we can use those franking credits to pay what's still a pretty attractive dividend yield. So we think we sort of do cover those limitations quite well in Mirrabooka.
Yeah, thanks, Kieran. Now, David and I were discussing before the difficulties of investing over the more recent period, and in many ways, the difficulties of investing at the large cap end of the market have been exacerbated when we move outside the top 50. So do you mind just stepping me through the performance of Mirrabooka over the last 12 months and the challenges of investing, in companies outside the top 50 on the ASX?
Yeah, sure, Paul. Look, so it's interesting. I mean, to answer that question, you really got to take you back to where we were, say, 12 to 18 months ago. And when we were looking at a similar chart then, we actually went to the trouble of putting the 1 year return right over to the right and flipped this order around to say we're a long-term investor.
Yep.
But we just had this remarkable year in 2021 where our portfolio went up 51% versus the benchmark at 35%. And reminding people, we own stocks typically on average for more than 5 years. So we weren't trying to optimize the return in that year. But what happened, we just had a particular year where the stars aligned on a lot of key holdings and the valuations went up a lot, and it took it to fairly inflated levels in a lot of areas. So I guess we were really trying to de-emphasize at that point in time and not take a whole lot of credit and say, look at how well we're doing, but just to try and remind people that we're long-term investors. And I guess that created a few headaches with the way we manage the portfolio, which I'll touch on briefly shortly, because it does mean you need to assess the risk and look at the valuation of some of those companies and take some profits in them. But I guess the key point for us is, when you've gone through a period like that and you're a long-term investor, I guess valuations do retrace back to some sort of mean average over time. And, you can't defy gravity. So we've seen elements of that through the portfolio. But I think two key points that we'd really want to reiterate with that is it's not an assessment of the fundamental quality and the long-term outlook of the companies we own. It's really just valuation to do with the onset of inflation and interest rates rising and seen a recalibration of valuation. But if you were sitting with the companies that we own in this portfolio as we do, and just talking to them about how their business looks and the opportunity set over 5 to 10 years, you wouldn't really be able to make sense of the moves in the share market in both directions, to be honest. So that's the first point. And then the second one comes to the chart we have in front of us now, Paul, which is just sort of say we've been here before. So there's a little bit of complexity in this chart, but what the blue line's representing is our 1 year performance relative to benchmark since Mirrabooka started. So we started in 1999, so that goes back to 2000, and just tracks how we've gone compared to our benchmark each month end over that period of time. And you can see there's times where we're doing really well and there's times where we're doing not so well on a 1 year view. And for obvious reasons, we don't manage the money to, to manage risk on a 1 year view or optimize returns on a 1 year view. We're long-term investors, but we just report back to people on how we're going on a 1 year view because it's interesting to them. But of much more value to us is that orange line you see on the chart, which is looking at the same metric, but measured over a 10-year rolling return. So again, we started in 1999, so that first was able to be tracked from 2009. And what that's showing is over that period of time, 2009 to today, if you look back at our 10-year return in Mirrabooka versus what you could get out of the benchmark, you've typically outperformed by 2 to 5% per annum when measured over 10 years. And we think it's a high hurdle, but that's what we're looking to do on a go-forward basis, and that's the number we're far more interested in.
Terrific. And there were some specific factors which you have on the right-hand side of this chart that were reasons behind the underperformance. You mind just touching on them very quickly too, Kieran?
Yeah, sure. Yeah, so that's right, Paul. So look, as I said, we're long-term quality focused. We sort of run our own race in the companies we think we should own, and we don't sit here and try and manage the risk of how our performance might look versus benchmark. We don't spend a lot of time worrying about, is it a risk not to own that particular company if it doesn't fit our process? So we've had a really weird market where, good companies have sold off very heavily because of interest rate moves. And look, there's logic to that. That's how the valuation formulas work. But on the other side, things like the war in Ukraine has meant, energy companies, coal companies have had a particularly strong rally, while the good companies with the long-term prospects have been falling on the other side. And then we've actually got a boom market in some stocks in the mid and small cap index, anything to do with battery technology for electric vehicles. So all the lithium stocks have had a really significant run. And where you do have some resource stocks in the portfolio, but they're very cyclical, and our approach tends to be that we sort of say we'll own them if we think they have something stand out about their business. So a low cost position, something unique in the world in terms of the quality of that asset, where we can sort of own that over a 10-year view and manage cycles, but we don't invest in themes or excitement about the demand for something in resources, because in our experience, you just get your fingers burnt because the cycles are so strong in both directions. And you typically look back after 10 years and say, there's great times to trade those stocks, but over a 10-year view, they haven't done as well as the really good companies that are growing their business.
We certainly try to bestow upon our clients the need for patience when investing. But the one thing that struck me about Mirrabooka was the number of companies that you've got in your portfolio that you've held 10, 20 years. I guess the question is, why? Why do you philosophically feel like you want to hold these businesses for such long periods of time?
Yeah, look, there's two key reasons. And I guess the first one goes back to the first point I made, the question you asked me about why be in companies outside the 50 leaders. What's good about small cap investing? And I guess what we're saying really is, rather than us being smarter than a lot of smart people who are trying to invest in the market and pick trends, what we're saying is we take our investors' capital and allocate it to companies that we think are really good companies. And we think if we do that well, the longer you're in them, the better chance they have to make us look good, in simple terms, because they will go and do what we hope they do, and they will win through different cycles. They will, I guess, prosecute their opportunity set and keep growing and generating that compound returns that you need to see to create real value over the long term. So if you find them, one of the tricks is to actually stick with them and not fiddle with it and not sell them because you're worried about some event that's coming, but let those businesses be the great businesses you think they are and let them deliver the returns. And I guess the second reason is it's for times like we're in now. Dave listed all the uncertainties in the world, and obviously people are very aware of them. But we get great reassurance when we sort of scratch our heads thinking what's coming next. I mean, we've been through pandemics and wars and inflation just in the last couple of years. But when you look at a portfolio set and you think, I know all the people running these businesses really well because I've been meeting with them for years. I trust them. And I don't worry about where these businesses are going to be in 5 years because I've seen how they've developed over the last 5 and 10. So I just get that really good reassurance that we're in good hands with the companies we own, and we don't have to predict and anticipate what's coming next, because, I mean, really, the track record of doing that over the last couple of years would have been woeful, with the uncertainty we've seen.
And Kieran, finally, do you mind just stepping me through some of the recent portfolio changes you've made within Mirrabooka?
Yeah, sure, Paul. So I guess the broad theme takes me back to the point I made earlier, which, while we're having a great time in 2021 with performance numbers and, things were flying, it creates its own headache. So we had a period of time there in 2021 where we never deviate from quality, but we really de-emphasised buying growth companies. We were moving into things like Computershare and Worley at the time, where we thought there was good relative value for good quality companies that was being, I guess, overlooked by the equity market. Moving into 2022, and with the retracement of prices across the sort of companies we typically want to own, the silver lining in that, it impacts performance in the short term, but it gets us back into our normal groove where we can now see better relative value for things that we think have really good prospects on a 5-year view. So, REA, we couldn't buy it in 2021. Domino's, we couldn't buy it, for large parts of 2021. So we've been buying into companies that we look out 5 years and go, we've got really good confidence in the growth of those businesses. Now, obviously, it's not an easy market. So, you can go early on these things and picking bottoms is impossible, but we've been just progressively stepping back at new price points and saying, if it hits that level, we'll buy a bit more. And so we think, while it was good to manage the risks in 2021 well, and we did sell a number of things, realize some gains through that as well, this is a more predictable way for us to create value in the long term. We think we'll look back at some of the things we've been buying in 2022 and the prices we've been achieving, and we'll be really confident in the prospects those companies have for earnings growth and therefore the returns that will generate in the portfolio over the next 5 years.
Yeah, thanks, Kieran. Finally, I've got a slide here that just shows the top 20 positions within Mirrabooka. And I think the thing that immediately struck me was while we're looking on companies that are outside the top 50 on the ASX, these are companies of significant substance, and certainly for Australian investors, well-known businesses. So yeah, I really appreciate your explanations on Mirrabooka. So I'm going to now shift to Brett, and I'm keen to talk about Djerriwarrh. So Brett, as I understand, the investment objective of Djerriwarrh is to provide investors an enhanced fully franked yield in excess of what the ASX 200 is paying. And the way that you go about achieving that is via using options. Do you mind just talking to me about the process of using the options to enhance yield?
Sure, will do. Thanks, Paul. Good morning, everyone. So just to quickly recap on that objective. So the primary objective of Djerriwarrh being to deliver an enhanced income yield. Simple terms, how do we do that? We own a portfolio of high quality stocks and we receive dividend income on those stocks. We then supplement that with option income, which is the bit that I'll focus on now. And then we subtract the modest costs of running the company. And as Mark said, the shareholders own all of our investment companies. So you have low management expense ratios, and they should actually reduce over time as the portfolios get greater scale. So they're the building blocks for the enhanced income yield. With the options, what we do is we sell call and put options, and in doing so, we earn premium income. And that is how we generate the option income to enhance Djerriwarrh's overall yield. So how do we do it? We're predominantly writing call options. We also write some put options as well, but there's a different risk return profile between calls and puts. So what we concentrate our activities on is writing or selling call options. A key measure of how we do it and how we manage it in the portfolio is a measure called call option coverage. So in simple terms, call option coverage simply means the percentage of our investment portfolio by value that we write call options against. And we typically run the call option coverage in a range of about 30 to 40%. We've set it at that level because with that level of call option coverage and the daily active management of the option portfolio, that is a level that we can generate the required call option income to enhance Djerriwarrh's yield. Now, all else equal, the higher the call option coverage of the portfolio, the more option income we could generate. But there's a trade-off in doing that. So the trade-off is generating short-term option income versus potential long-term capital growth. And getting the balance is the key, and is actually one of the things that we've changed a fair bit of in the Djerriwarrh investment company over the last couple of years. So the slide shows how we've gone on the key objectives of Djerriwarrh. And in terms of the enhanced yield, if we look at the left-hand side here, we're comparing the light blue bar, which is Djerriwarrh's yield. So that's Djerriwarrh's dividends over the last 12 months divided by the net asset backing. That was 7% as at the end of September, compared to the green column, which is the market's dividend yield, so the ASX 200 of 6.1%, both as at the end of September and both grossed up to include franking levels. So the enhanced yield of 0.9%, that compares to our target is around 1%. So that's the level of enhancement that we're looking to do to the market yield to generate a higher income yield for our shareholders. The second chart just to touch on is really how the portfolio has performed, which is the basis for the capital growth. And that hasn't been at the level that we want it to be, particularly over the long term. And so that's a key focus for myself and the investment team, certainly at the moment, is to deliver that better balance between the enhanced income and the long-term capital growth, as well as growth in dividends over time as well.
I'm particularly fascinated about the role these options play in the portfolio, perhaps in more difficult times like we have right now, and particularly how active you've got to be with those options when we are experiencing volatility.
Yeah, it's a key part of the process. So the option portfolio is truly managed on a daily basis. And I mean, one measure of that is the number of transactions that we do per year. So for the last financial year, we did over 1,500 transactions, which are predominantly the option portfolio, because the investment portfolio of stocks is largely a buy and hold approach, like what you've heard for Mirrabooka and AFIC. So it's the option portfolio where there's really intense, daily active management. So the approach that we typically take, so we've heard we set the call option coverage at about 30 to 40%, but it varies a lot across the individual stocks within the portfolio. And the options that we tend to write are call options, like I said, and they have expiry dates about 3 months into the future. So we're looking at 3 months sort of contracts with our options. But you have the scope to manage them a lot in the meantime. And we look at obviously our bottom-up stock valuations and views in terms of how we rate stock and value it, but we particularly respond to market conditions. So the chart that we've got here is it's a top-down overview of all those individual transactions that have happened during the year, and it's set against the market performance over the last 12 months. So that's the green line, the ASX 200 index. There's some of the key market events of the last 12 months annotated above the line, and below the line, we mentioned some of the key moves in the option portfolio. So to give a couple of examples, 12 months ago, the ASX 200 was at about 7,200, and our call option coverage at that time was 30%. We increased it in response to the market level increasing over the subsequent month and a bit, and we took the call option coverage up. And then as the market largely tracked sideways and even down for a period over the subsequent months, we were able to close a lot of those positions early. So rather than waiting for the option contracts to expire in roughly 3 months' time, we can act early, move the portfolio so that we lock in significant amounts of option income much earlier than otherwise would have been the case. And then if the market subsequently rebounds, rewrite that option coverage. So the daily management of it is quite important. And if we go, maybe skip to the sort of the end of this chart here, we can see that when we move to sort of July, August 2022, after the market had fallen a lot, again, we used that period to close a lot of the call option positions that we had, again, acting early, locking in profits that we'd already earned, taking the exposure off the table, and banking quite a bit of option income for this financial year. And at the same time, with those lower market levels, we started to selectively write some put options. So heading into July and August, we didn't have any put option positions in the portfolio. We'd had some previously, but we closed them out early to, again, book the income early. But with markets coming back to much more reasonable levels in terms of stock valuations, we decided to write some put options in some of our more preferred options. And again, this is an extra component to generating good levels of option income through the year. So the upshot of all of that is that with the settings that we've got with the call option coverage, 30 to 40%, plus some select put options, and then managing it on a daily basis and taking advantage of the market volatility, because higher volatility is a positive for us as a writer or seller of options, we've been able to lock in quite a bit of income for this financial year. So overall, as we sit today, the option portfolio is in really good shape in terms of potential income for financial year 23.
Thanks for that explanation, Brett. So look, we've obviously focused on Djerriwarrh's objective of generating an enhanced yield, and a yield of 7% is particularly attractive, and we've focused on the use of options to assist to generate that yield. But I guess underpinning this listed investment company is a portfolio of high quality stocks. So I'm very keen to understand, we obviously spoke to David about AFIC, and we spoke to Kieran about Mirrabooka, and one's, the way both are investing. So how do you go about constructing the portfolio for Djerriwarrh?
Yeah, the portfolio construction approach for the stocks that we own, so like you say, separate to the option portfolio in this sense, is similar to our other portfolios, in particular AFIC. So the key for us for Djerriwarrh is a portfolio of high quality companies, purchased at attractive valuations, and to have the right balance between income and growth. So we're certainly not purely focused on just higher yielding income stocks. That's not the case at all. And that's why I started by giving those building blocks of our enhanced yield. It's dividend income plus option income. So it's not just investing in what the market might rate as sort of high yielding stocks, because we want to deliver income and growth over the long term. So you'll see here we've got the top 20 holdings of the portfolio again at the end of September. And the broad overview of that would be you've got some what we think really high quality blue chip companies, BHP, CSL, Woolworths, Coles, Wesfarmers. We've got some stocks that are in there primarily for income, but income that will grow over time, but in a modest fashion. And some examples there would be Transurban and SCA Property Group. And then you've also got companies that are in there predominantly for growth, companies like Mainfreight, Car Sales, and Goodman Group. So the key theme of any company that we own in the portfolio is quality first, and then getting the mix of income and growth right. Some of the key portfolio stats we've listed there just for interest's sake. So at the end of September, the portfolio was worth just over $800 million. We owned 49 stocks in the portfolio, so a bit less than AFIC. Call option coverage at the end of the period was 29%, so just below the bottom end of our target range, and that's really a result of closing a lot of call option positions early to lock in income. Actually, subsequent to this, we've rewritten some positions, so call option coverage as of today sits a little bit higher than 29%, so taking advantage of some of the increases in the market that we've seen in recent days. And the put option coverage is 2%, which is a result of selectively writing some put option positions after the market had fallen. And the net tangible asset backing of the portfolio is $2.81. In terms of recent changes, maybe just to touch on to give a flavour of that. So we've sold out of a couple of holdings, InvoCare and Sonic Healthcare. They were both small positions, and we lost conviction as to what they really bring to the portfolio. We didn't find them compelling anymore from either an income or a growth perspective. We sold a little bit of Iris, which was really around risk management. That was before the downgrade, so I wish we'd sold some more, but we still hold some Iris. And we've added to a lot of companies that we already own, particularly these top 20 holdings, as we started to see the better value in the market that the rest of the teams talked about as well. So particularly adding to BHP at really good prices. We bought the banks selectively a month or two ago, really Westpac, Commonwealth and NAB. We've added a fair bit to SCA Property Group, Equity Trustees, and we've bought some Wesfarmers. So overall, the goal, increase the quality of the portfolio always and get that balance of income and growth right to fulfill Djerriwarrh's objectives, predominantly enhanced income, but also long-term growth in capital and dividends.
Thanks for the explanations, Brett. We're out of time. I could keep talking forever with the access that we have to you guys, the portfolio managers, and of course to Mark. So on behalf of the GFM clients, Mark, David, Kieran, Brett, thank you for your explanations this morning of the high quality listed investment companies that our clients are investing in, Australian Foundation, Djerriwarrh and Mirrabooka. We really appreciate your time, and best of luck for the rest of the year, and hopefully you get a well-earned break at Christmas time. So thank you.
Thank you.
Thanks, Paul.